Hi, I'm Ray from W.consulting, and today I'll be talking to you about IFRS 14, the Regulatory Deferral Accounts standard, which was issued back in January of 2014 by the IASB. The standard was issued to address the accounting impact that regulation has on the supply and pricing of particular types of activity that are undertaken by private entities. And when you look at the regulation that we're dealing with here, it's regulation by government on the supply of these sort of services, goods and services. Now, typically, the sort of organizations that we're dealing with here are organizations that are in the utilities space and will provide services such as gas supply, electricity distribution, water distribution, that sort of thing. Now, if you think to why regulations are often put in place in such scenarios like this, they serve a dual purpose. From the supplier's point of view, is to enable the supplier to recover specified costs that they incur as part of the process of providing the service, as well as a return to enable them to stay in business. At the same time, when you look at the customer side of things, it's to protect the interests of the customers, in that the customers will then not be open to the volatility of pricing that might otherwise result in the event that the supplier could simply go back and change the pricing whenever some of their input costs vary. Now, if I give you a typical scenario of the sort of situation that we're dealing with, as a supplier, if I've agreed with my regulator that I should be generating a 10% return on the services that I'm providing, if I happen to generate a 12% return, then basically I've over-recovered. So what I need to show in my books, instead of showing a 12% profit, is to take the 10% that I should have show that as a profit. The 2% differential, well, that's a liability, because from the next period onwards, I'll then possibly be given a lower tariff to compensate for the higher profit that I generated previously. If my scenario has gone the other way, and I've generated a profit of 7% when it should have been 10, well, then I've got an asset on my hands in that I'll then be able to apply for a higher tariff increase in the following period. So what suppliers will do in a situation like this is that they'll keep track of these deferred amounts in separate regulatory deferral accounts until such time that they're able to recover them through future sales of the goods and services that they're providing. Now, if you look at where we are as IFRS reporters, currently IFRS has no provisions at all that deal with this. So what organizations that are applying IFRS do is that they'll basically not recognize these deferral account balances in their financial statements. Certainly not on their balance sheets. What they'll do is that they'll recognize these amounts through their profit or loss as and when they arise. However, we have some jurisdictions around the world that permit the recognition of these excess costs or excess income as assets or liabilities, depending on which way it has gone. Now, the issue here then becomes, what happens if I'm operating in such a jurisdiction and I then move over onto IFRS? So IFRS 14 has been issued to deal with exactly that. So for any organizations that are looking to apply IFRS for the first time, then IFRS 14 will allow them to continue using their previous GAAP accounting policies for their rate-regulated activities. Now, the application of IFRS 14 is not mandatory, but if you're a first-time adopter of IFRS and you're eligible to apply the standard, then absolutely by all means you can apply the standard and carry on doing exactly what you were doing previously. However, there is a bit of a catch to this. You'll find that there'll be no impact on your accounting from before, but there'll certainly be an impact on your presentation of your financial statements. Now, in your financial statements, specifically the statement of financial position, there'll be an additional 2 line items that will need to be shown in there. To the extent that you've got a regulatory deferral account balance that's a debit, you'll need to show this amount after your total assets line. To the extent that you've got regulatory deferral account balances that are in credit, then you'll need to show this line item after the total liabilities line. That's in the statement of financial position. In your statement of profit or loss and other comprehensive income, any movement that you have in the regulatory deferred account balances for that particular reporting period will need to be taken through profit or loss, if they belong in profit or loss. To the extent that you've had a movement in regulatory deferral account balances that relate to items of other comprehensive income, because of an accounting policy choice that you've made, then you take that through other comprehensive income. Now that'll be the presentation side of things. Additional disclosure will also be required in your financial statements that deals with the risk, the nature of, and the extent of any risks that you might be faced with arising out of these regulatory deferral account balances that you've got. And this will need to be shown in the financial statements. Now you might ask the question, well, what happens when I'm currently applying IFRS and I have these amounts that I'm keeping on the side, that I'm keeping track of on the side? Well, the ISB is currently undertaking a project that will deal with the rate regulation. They're going through a thorough consultation process that will ultimately result in the issuance of a standard on rate regulation. What the ISB have said is that in the second quarter of 2014, we should expect a discussion paper that will deal with this issue, and ultimately a standard will then be issued, as I mentioned. In the meantime, anybody who is moving off any other accounting framework onto IFRS, they can apply IFRS 14 with no problems at all. IFRS 14 becomes effective for all financial periods beginning on or after 1 January 2016. Earlier application of the standard is permitted to the extent that it's within the scope of the standard. To the extent that you decide to early apply the standard, then you'll be required to disclose the fact that this is what you have done.